Good morning and Happy New Year to all our listeners. Today's episode marks the beginning of an exciting year for the crypto world, and we're kicking off 2025 with a highly relevant topic that's been gaining traction over the past year: blockchain fragmentation. I'm joined, as always, by my co-host.
That's right. With the exponential growth of the crypto industry, it's becoming increasingly clear that blockchain fragmentation is a major problem that must be addressed this year. We've seen the number of monthly active addresses triple from 70 million in 2023 to over 220 million in 2024. You'd think that with over 300 chains listed, the ecosystem would be able to cater to the needs of all types of users sustainably.
Exactly. However, the reality is that this rapid growth has led to a highly fragmented landscape, making it difficult for users to navigate and for developers to build applications that can seamlessly interact with different chains. We're seeing a situation where different blockchains are operating in silos, which is hindering the industry's ability to achieve true interoperability.
That's the key point here. Interoperability is crucial for the long-term success of the crypto industry, and it's clear that the current approach to blockchain modularity isn't working. We need to take a step back and reapproach this from a fresh perspective, which is exactly what we'll be exploring in today's episode.
So we'll be diving into the specifics of blockchain fragmentation, including its causes, consequences, and potential solutions. We'll also be discussing some of the initiatives that are already underway to address this issue, such as the development of cross-chain bridges and interoperability protocols.
And it's not just about the technical solutions. We'll also be exploring the governance and regulatory implications of blockchain fragmentation and how these factors can either hinder or help the industry's efforts to achieve greater interoperability.
Throughout the episode, we'll be referencing some of the biggest market-moving stories of the past year, including the rise of decentralized finance, DeFi, and the growing adoption of non-fungible tokens, NFTs. These trends have highlighted the need for greater interoperability and have put pressure on the industry to find solutions to the fragmentation problem.
So let's start by taking a closer look at the current state of blockchain fragmentation and some of the key challenges that it poses. We'll then explore some of the potential solutions and initiatives that are underway to address this issue. It's going to be a fascinating conversation, and we're excited to share our insights with you.
Building on what we discussed earlier about the growing importance of decentralized finance, it's worth noting that the year 2024 has been particularly challenging for projects and coins that prioritize user anonymity. We've seen government-led efforts to crack down on services like coin mixing, with the teams behind Bitcoin Fog, Tornado Cash, and Samurai Wallet all facing their fair share of court battles.
That's right, and what's concerning here is the message it sends to users who value their digital privacy. The notion that using a service that helps maintain anonymity on-chain is somehow illicit or suspicious is problematic, to say the least. It sets a precedent that could have far-reaching implications for the entire industry.
Speaking of implications, we've also seen some exchanges delist so-called privacy coins, citing regulatory pressure as the primary reason. It raises questions about the long-term viability of these projects and the role they play in the broader crypto ecosystem.
Absolutely, and it's not just about the specific projects being targeted, it's about the principles at stake. If we allow governments and institutions to dictate what forms of financial privacy are acceptable, we risk undermining the very foundations of decentralization and the trust that users have in these systems.
So that being said, it's worth acknowledging that there are legitimate concerns around the use of these services for illicit activities. How do you think the industry can strike a balance between preserving user anonymity and addressing these concerns?
Well, for one, education is key. Many people still view crypto as the Wild West, where anonymity is synonymous with illicit activity. But the reality is far more nuanced. We need to be having more informed discussions about the importance of digital privacy and how it can be preserved without compromising the integrity of the system.
That's a great point, and it's also worth noting that some projects are exploring alternative solutions, such as zero-acknowledge proofs that can provide a level of anonymity without compromising on-chain transparency. Perhaps these innovations will pave the way for a more balanced approach to digital privacy in the future.
Exactly, and as we look ahead to the rest of 2024, it's clear that this conversation is far from over. The ongoing debate around digital privacy will undoubtedly shape the trajectory of the crypto industry in meaningful ways.
Building on what we discussed earlier about the rise of central bank-issued digital currencies, I want to bring up a thought-provoking article I came across titled, "Why a U.S. Bitcoin Strategic Reserve is Critical to Fending Off China." It touches on the idea that the U.S. needs to rethink its financial strategy in the face of China's growing economic influence.
That sounds fascinating, especially in light of our previous conversation about China's digital yuan and its potential implications on global finance. Can you dive deeper into what this article is proposing?
Essentially, the author argues that China has been waging a decades-long war against the US dollar, trying to undermine its status as the global reserve currency. By establishing a strategic Bitcoin reserve, the U.S. could regain some of its lost influence and stay competitive in the evolving financial landscape.
That's an interesting perspective. It's clear that the US and China are engaged in a high-stakes game of financial chess. But how would a Bitcoin reserve help the US counter China's moves?
According to the article, finance is increasingly becoming a weapon of war, and the U.S. needs to adapt its strategy to stay ahead. By accumulating a strategic reserve of Bitcoin, the U.S. could demonstrate its commitment to innovation and forward-thinking, which could help maintain its economic edge.
I see what you're saying. It's almost like a digital age version of the Cold War, where the US and China are competing for ideological and economic supremacy. But what about the potential risks and challenges associated with establishing a Bitcoin reserve?
Great point. The article does acknowledge that there are valid concerns about the volatility of Bitcoin and the potential for market manipulation. However, it also suggests that these risks can be mitigated through careful planning and management.
That's a fair point. And it's worth noting that the US has a history of using strategic reserves to stabilize markets and promote national interests. Perhaps a Bitcoin reserve could be seen as an extension of this strategy.
Exactly. And as we discussed earlier, the rise of central bank issued digital currencies is already changing the game. By embracing Bitcoin and other cryptocurrencies, the U.S. could be seen as a leader in the digital finance space rather than playing catch up.
Well, it's clear that the US and China are engaged in a complex and multifaceted competition. We'll have to keep a close eye on how this plays out in the world of finance and beyond.
We're still reeling from the massive price drop of Solana NFTs we discussed earlier. It's interesting to see how different collections are performing, especially when you consider the momentum some of these projects have built up over the past year.
Building on what we discussed about NFT market trends, one collection that's caught our eye is CryptoPunks. Decrypt just named it their 2024 NFT Project of the Year, and it's clear why. Despite a strong challenge from Pudgy Penguins, CryptoPunks has managed to hold its ground as the most expensive NFT collection in the world.
Speaking of Pudgy Penguins, their recent surge was quite impressive. From a floor price of $19,000 at the start of November to over $60,000. That's a significant jump. And with their upcoming token airdrop, it's likely they'll continue to attract attention from collectors and investors.
The key to CryptoPunks' enduring success, though, lies in its brand recognition and historical significance. As one of the first NFT collections on the Ethereum blockchain, it has built a loyal following and become a status symbol of sorts in the crypto world.
That's a great point. When you look at other collections like Pudgy Penguins, or even Bored Ape Yacht Club, they've managed to create their own unique identities and communities. But CryptoPunks has a certain nostalgic value that's hard to replicate.
It's also worth noting that the NFT market is still relatively young, and we're seeing new trends emerge all the time. Take, for example, the rise of art and fashion-focused NFTs. Decrypt's Scene Hub is a great resource for staying on top of these developments and discovering new artists and collections.
Absolutely. As the NFT space continues to evolve, it'll be interesting to see how different collections adapt and innovate. Will CryptoPunks continue to reign supreme, or will new challenges emerge to shake things up?
One thing's for sure, the world of NFTs is never dull, and we can expect plenty of surprises in the coming year. We'll be keeping a close eye on these developments and bringing you the latest updates as the market continues to unfold.
I think we can all breathe a sigh of relief as the day comes to a close, with Bitcoin, Dogecoin, and XRP rebounding after that sudden post-Christmas decline. We saw the price of Bitcoin dip as low as $91,816 on Monday, which is the lowest price we've seen in over a month.
That's right, it was starting to look like the holiday season wouldn't be so merry for crypto investors. But it seems like the market has managed to bounce back, at least for now. We did discuss earlier how volatility is to be expected during this time of year, and it looks like that's exactly what we're seeing.
Exactly, and when we take a step back and look at the bigger picture, it's clear that this dip was just a minor setback. We've seen Bitcoin recover from much worse in the past, and it's still in a position to finish the year on an upswing.
I completely agree. The fundamentals of the market haven't changed. And if anything, this dip has given investors a chance to buy in at a lower price point. We've seen this pattern play out before, where a brief correction is followed by a surge in price.
And speaking of surges, let's not forget the last time Bitcoin touched this price point was back on November 26, ahead of a significant surge. Could we be seeing a repeat of that scenario? It's definitely possible.
It's also worth noting that altcoins like Dogecoin and XRP have followed suit, rebounding alongside Bitcoin. This could be an indication that the market as a whole is regaining confidence.
That's a great point. And as we wrap up today's show, I think the key takeaway is that despite the volatility, the overall trend is still looking bullish. We'll be keeping a close eye on the market over the coming days to see if this rebound sticks.
Absolutely. And as we head into the new year, it's going to be interesting to see how the market responds to the changing landscape. One thing's for sure, though, crypto investors are in for a wild ride.
Well, that's all for today's show. Thanks for tuning in, and we'll catch you all again tomorrow.
And don't forget to follow us on social media for the latest updates and analysis. Until next time, stay crypto savvy.
And as always, this is signing off.